So I'm making part 4 of this tax equity, solar tax equity model. And I've gotten to the part where we're going to address issues like the inside basis. And I think I'm going to even start renaming this as I go along. Call this inside capital. Now, oh, I had to take a big sigh. Excuse me. I'm not even going to turn off the video for that. When I look at other people's models, and when I first look at the models, I had two reactions. I was working on my first thing, and the first reaction was to give up. This is absurdly complex. What does all this stuff mean? This 734 step up, uh, this DRO, the deficit reduction obligation. Why do you compute the minimum? Why do you compute the inside capital and the outside basis? Why do you even call it the outside basis and the inside capital? And then I got to the minimum gain, and I just almost said, "Oh no!" And it took me a long time. Hopefully, it won't take you that long, and you won't do the same thing that just about everybody who I've run into this situation does, and that is they go and they try to find another model. And so what I've done is, if you give me an email, I've collected some solar models and some wind models and tried to come up with a database that allows you to copy the various things. All right, enough of that. Now, I think the way we should address this is it would be better to think just a little bit about the tax authorities and why they might do things. Now, I've also, just to get started, in the last video, I got in trouble from my friend who said, "Yeah, you idiot, you can't use 99%, 1%. These days, people use 99, 67, and percent for the income, and they don't use 99%, and maybe they'll use something else." So in the and then we have so we might in here switch it from 99 to 67 and then to 5. And these, you remember, this was the discussion we had about safe harbor, a boat in a safe harbor to protect yourself. Now, I still believe you can get 99% here, but the reason this 67, and this shouldn't say don't enter data here, okay, but I better fix this. This is what I'm doing as we go along. How do I do this? I go to data, and I go to data validation, and maybe I'll hit clear all, and then I'll put Control C, and then Alt E S N, and Control C at Alt E S N. Now, what I've tried to do on my website, so let's start. Ooh, get rid of it here too, just in case you had some more. ESN. So in our courses, unlike what I'm doing today, we'll stop and have some discussions. Okay. Oh, shit. Okay. If you even want to waste time with that kind of crap. But if you have questions about why the minimum gain is computed and why the minimum gain is computed in one way on the inside basis, and what is the meaning of the DRO? Is it really important or is it not important? And what happens if you talk to a tax accountant and they won't give you direct answers? What should you do then? these are the types of issues we're going to discuss. Now, what I've tried to do in my website recently is I went to these accounts, and for the inside capital, I'm just going to talk about a couple of things here. The inside capital, I tried to make a crazy little stylized example. And the IRS says, that's the tax authority, they say, well, when the equity balance goes to zero, that's evidence that you do not have, and did I put some notes down here? I didn't put it on this one. You do not have a economic interest, and there's a better word for this, and I'm losing this word, and I'm not going to stop the video just to find this official kind of word on. If you don't have at-risk capital and all that, you don't have a real economic stake in the investment, whatever you want to call that. Okay, and they say, well, when your equity capital goes down to zero, and think about equity capital. Equity capital, think about that just as like any other equity capital account. It's just the opening balance. You put the paid-in capital, that adds the equity contributions. You take away the dividends, that subtracts it. You add the income, and and then you get the balance. And they say, well, what happens if that equity capital goes down to zero? That means you don't have an economic interest in the project. Here's the way it could go to zero. You pay yourself a whole bunch of dividends. If you pay yourself so many dividends, then it could go down to zero. Or the income, you take all the tax depreciation, and the income, the benefits you get for tax depreciation are more than the equity you put into the project. That would seem to be a good test. But you have to be a little careful here. Because when you really think about it, the equity you put in is an after-tax number. You put in equity to get the tax benefits, and if you put in equity of 100 and the tax benefits are only at 21%, which is this lower tax rate, then you put in 100 just to get the depreciation, but the depreciation is only 21%. So that test, when you really think about it, is not such a great test. But we're going to live with it, and we're going to go through all the games you can play and the fudging around you can do. Now, the IRS also puts in two kind of tests. They put in one, an equity capital test, and then that's called the 704B test. Some people call this the fair market value. Some people, I hate these names. It's not fair market value. It always uses, or the book basis, it always uses the tax depreciation. And there's some rules how you do it. And then they say, okay, well, then we can fudge around with this thing. We can use this thing called the deficit reduction obligation, and that is only applicable to this account. It's not applicable to the other one, which is the outside basis. Now, the outside basis, when I go through the models, that can limit both of these things, both of these accounts can limit the amount of negative income you have when the accounts get negative. And this outside basis is defined as kind of just a tax basis. And the way to think about this, and why people don't just tell you it straight off, it gets me crazy. The outside basis is a kind of like an asset account. We'll see why. And the inside or capital account is like an equity capital account. And you go through the models and you try to copy them and you don't understand what's going on. Now, when you do go through the models, when you get to the outside basis, so I've tried to put it and hide things and restructure things. I've made another video on how you can look at other people's models and restructure them. The outside basis is much more consistent, and it always has this thing called a 731 capital gain. It always has a suspended losses, and that's like a NOL, and we'll see how all of those things work. Okay, And then you think, I got it down. I got it down. I got this all. I have this already. I'm okay. And then you go to the last one. And then you go to this thing called the minimum gain. And I've seen a lot of people say, I'm just not bothering with this. The minimum gain is only affected if you have non-recourse debt at the partnership. Now, if you don't have non-recourse debt at the partnership, you call it back leverage. It's only that it's got to be paid by only the sponsor, which is kind of fine because the sponsor gets most of the cash anyway, so it kind of works. But if you put non-recourse debt in, and that's been, and a tax accountant said, why in the heck don't they put non-recourse debt in? Because you can avoid these tax problems if you put non-recourse debt. Now it took me so long and I hated this so much. This is when I just about went crazy and just about gave up. It sounds like, and they call minimum gain, it sounds like it's some sort of capital gain or something. What it is you take the debt, and when the debt exceeds the asset value, and as long as it's positive, you call that a minimum gain. And I put this example here. And if you don't do this, and I'll just go through my tiny little example here. So let's say your asset cost 1,000 and your debt is 500. And then you just measure the equity capital, okay? So you put 500 of equity capital in. And then you depreciate the asset. And when you depreciate the asset, the idea is the equity holder is supposed to get the depreciation of the asset, aren't they? They're supposed to get that. But if you finish depreciation of the asset and the asset goes down to zero and you still have 500 of debt on, then you could have a negative equity balance because this is zero and and you've depreciated the asset, so you put in 500. You got, and this assumes that all the dividends are paid out and interest, whatever income is paid out as dividends and all that. And the negative 500 then gets, that negative 500 is where the IRS goes crazy. When you have a negative amount in one of these accounts, when you have a negative amount in one of these accounts, then the IRS says, nope, nope, sorry, you got to pay tax on that. Your taxable income has to go up. So just imagine that extremely simple example where, okay, you have debt, that makes the equity balance go down to below zero. If the equity balance goes down to below zero, you're finished. You've got to depreciate. You've depreciated those assets, but now you've got to kind of undepreciate them. You don't get the benefit of that depreciation you were supposed to get. So that's the basic idea. And if you understand a little bit of these ideas, then you can get started in the modeling. Then you can start to copy things. Now, let's go through some of this. So, okay, so I changed that and wasted a little bit of time on that. And then we're going to go to the tax investor accounts. And just to review, we started with these preferred distributions. By the way, these preferred distributions should drive the back leverage people a little bit crazy. Okay, and then we, if they're, because they're senior to the back leverage, that's the next video. God, I've got enough in this video. Stop talking. And then we go through this partnership, and this is where I put some of the other percentages in, the 67% instead of the 99%. And then we walk through the buyout option, and there was a little discussion that the buyout option should be a fair market kind of option. And then we can see, okay, here's the tax equity IRR with no stranded taxes. Now that's pretty low. This 22%. Oh, this is so high, it's got a num or low, 22%, 27%, okay, 18%. These are not that high. I wonder if oh, that's because of my 67% stuff. I'm going to go and change these and make this 99%. So these need to be colored in blue. And the tax investor, if I give that tax investor 99%, then that tax investor, when you accumulate all the cash flow, oh, look at that enormous return they get. But here's the problem with that return. You don't kind of get it in the end because these gigantic negative payments you get, these negative payments will not be really available. So we'll switch it from 67 to 99 and go through it. Now, my complaint about a lot of the other models that I see is they're all very, detailed. They all go through these fine things, in which I should do as well, but you lose the ability to see what's really, really going on. You lose a little of the strategy. Now I'm going to make this whole model into a periodic model and then throw it on the internet and hope it disrupts some things a little bit. Now, what we're going to do is compute this inside capital for the tax investor. And I'm going to even make some notes, also called FMV, book, etc. Okay, so it's not official. There are some sorts of adjustments you can make. Now, the one thing about this one is we'll see there's something called a stop loss. And the stop loss, available for stop losses that limit negative income. Okay, all right, a negative equity balance. That's why we call them stop losses. It should be stop negative equity balance. And hopefully you can learn just a little bit about what all these, oh, I can't get words out. DRO again, I might even put this in because I call it dividend refund or deficit restoration obligation. And we'll see. Now, remember, this is a partnership. I shouldn't tell you stuff about my personal life, but I've made some stupid decisions in my life. Oh my God. Okay. Yeah, ages and ages ago, I had an ex-girlfriend. Oh God, and the best decision was to end that partnership. But her name was on the title of my house, and then so he's got the rights to it's a little apartment. But that's a partnership, and these lawyers had said, "Oh God, you can't do anything about it. But if you make all these, if you make, put a new sink or something in, well, that's your, the some kind of court would say this is all a partnership." Oh God, I don't know what to do about this. But why did I tell you about this? I should have never said it that. But the partnership, you can kind of do whatever you want with a partnership. That's the point I was trying to make. You can switch things around, move things around, negotiate the book equity of a partnership can be manipulated a lot. Okay. So then the next thing that happens is there's this thing from an accounting standpoint. It's called a 734. And how you could remember these horrible things. The 734, I'm practicing, obviously. Maybe you have to show you're smart in an interview or something. You have to show that you know these things. If you have more dividends, if you issue more dividends than the balance of the equity. Now, I'm trying to think through this one. I should know this much better. The tax said, well, that's like selling. Maybe, let's say you have a company that's worth on the stock market 100, and they issue a dividend to one of their investors that's more than the value of the company. Well, you could say, well, that's like selling your shares somehow. You've sold all your your interest out. You don't. You've sold it as a gain somehow, okay? So they call that, so you write up the value of the asset for that. And there's a potential tiny, tiny, worthless to worry about circular reference on the opening balance. And people who get upset about that circular reference, even I, who's Mr. I go crazy about circular references to do that. And then you have this minimum gain. And I'm doing all of these things just to introduce the inside capital account. And here's where the one thing you do know about this minimum gain, you put this and you put the non-recourse debt in. So I'm going to now do something that I find a little scary. I'm going to put project 67, and I made this 33, and then what we want to see is what happens to the equity IRR with stranded investment, with no stranded taxes versus with stranded taxes. And perhaps I should really change it here, and make it more, it's a little bit inconsistent to do it like this. Let's put the 99% back here. If I put the 99% back here, the IRR goes up for this, but it kind of doesn't even help. It was 9.54, and if we put 67% in here, it was 9.22. So it didn't really help all that much to take all that additional tax depreciation because of all the constraints. You can't use it anyway. And for these people, there's an argument that we should really look at the pre-tax IRR for this one, not the after-tax IRR. And maybe I should move later. I'll move the pre-tax to above the after-tax. See, that's what I get. And right now, this is without applying debt. If I apply the debt, it's not a big deal actually in this one. Then the IRR goes a little bit higher for this one, and it goes higher for this one. Okay, you can see that. And if I okay, we will go through for the tax investor some of these rules and just continue now. Okay, so this is the minimum gain is defined as the assets of the company minus the debt, and you do that in order to not be screwed by the depreciation. That's really the theory. And then what they say is, well, when eventually this minimum gain becomes negative, okay, we're going to call that this famous minimum gain chargeback. It seems so arcane and so ridiculous, but basically it's the the way, okay, when we release all the debt, our equity goes up, and the tax authority tries to get that little benefit they gave you back. Now, I didn't explain that one well at all. I'm going to put that on my website and spend a little more time on it. I've just been working on it, but you can go through this, okay? Now, when we go through the capital account, okay, we're going to eventually compute a subtotal, okay? And I suppose, other people may suggest that I should use here, and I can see their point, that you could, excuse me, I'm just looking at some of these, you could make an argument to put negative numbers as negative. I agree with that kind of here. I don't want to be idiotic about some of my stuff. Okay, so as any equity balance account, let's start with the same thing. Now, you first put the paid in capital, investor equity. How about paid in capital? That's just straight from the sources and uses statement. And then you have distributions. And remember, these distributions, there's no after tax here. This is cash distributions. Okay, and remember that everything is pre-tax in this whole thing is pre-tax. And then you put the loss and the gain, and why you'd separate them here, God only knows, but some people did. So, and then I've got a mistake because this is this is add the income from the sale, and I've got it here. So I've got to pause this video again and fix that. And perhaps I have not emphasized this as much. I don't know how you could watch this video. I have no idea. This is so arcane and so horrible. But basically, I split the income from the sale, and this is the income or loss after depreciation, but but pre-tax, and it's always pre-tax. And this is the inside capital account, and we better put this for the tax investor. And everybody computes the inside capital and the outside capital for the tax investor and also the sponsor slash developer. But that's kind of a waste. Really, well, I'll do it too. Of course, everybody does it. You have to do it. You have to balance it out. And this equity account, by the way, when you look at your partnership balance sheet, down here we put a partnership balance sheet. When you add the equity balances together before you make some of these funky adjustments, it better all balance. In fact, that's what one of the things I read. I read a lot of crap about this, okay? And that's what they say to do, and you could put all of these kind of adjustments in there. And then you take less 50% of the ITC. It sounds like it's after tax all of a sudden, but this is like a loss from the lower basis, the lower tax basis. Or you could call that like a depreciation right away. That's like an income. Okay, so that's a less. And I almost should put that as a negative. I realize that I should, but I'm afraid to right now. Although we only have a couple ones that are less, and I'm subtracting them, so I'm going to leave them for a moment. No, I'm not. Look at me, contradict myself. What a idiot I am. Now, I changed this. In this ITC adjustment, remember, control square bracket, you should be able to find this. And you should keep, this is the problems with these other models I've looked at, to track these things, and they all have this quarterly adjustments and all that. And that's going to be our next thing, to do this in a very, very clean, a very, very clean kind of way. And so we have the subtotal. Now, if I would change this and make the inputs, go find the right inputs. If I would make this input 99% again, now we can kind of see what's really happening. Then I'm going to leave that here for a minute. Then we suddenly have a negative capital account. Okay, and now I'm going to put the deficit reduction obligation down to 0. Okay, now and so in this one we just have it for one thing. Let's look at a couple of the others. We have it in a couple of years. but it's kind of interesting. It's a function of the pattern of the tax depreciation and the dividends and all that, and it seems to kind of come here. Now, this, I called it potential reallocation of income, also called stop loss. Okay, and here's the problem with this account. By the way, if I click off of this one and don't put a minimum gain, so I should have said this much more slowly. I saw one model where they didn't put the minimum gain in for some reason. Okay, and when they didn't put the minimum gain in, you get a very different, you get much more negative values here. Okay, so if you're uncertain of one of these arcane tax aspects and you have to call your tax lawyers and everything else, my suggestion is to put put the options here, put a bunch of options here, and say, okay, we don't have to include a minimum gain. The minimum gain chargeback, we don't have to include. Now, I have to add that minimum gain chargeback into this, and then shared liabilities, maybe I want to include those, maybe I'm not absolutely sure. I'm pretty sure of those, by the way. And what happens when the asset suddenly gets sold and the debt goes down? What happens to this exposure? We'll come to another issue. I didn't explain that one very well either, but I just wanted to introduce those kind of things. So this stop loss, I call potential reallocation, that can increase the taxes. That's the point. That's the whole point of computing this inside basis. Now, what you could do is you can have a DRO, and this DRO is computed in K130. Let's go back up to the DRO. It's computed on the basis of the equity balance. So it's computed as a percentage. So if we and that's the tax equity balance. So that we can have if we had 100% DRO, that would be the equity balance. This one, it makes a little more sense. I computed, if we have a 50%, this is the amount. Now, if we have a DRO, okay, this is the big deal about a DRO, is that they, where am I? Oh, I have to go down a little more to my inside basis. We compute this subtotal, and then you can use this DRO here. We have the enough of the DRO to reduce the exposure. So I think this is a little backwards. Again, I think we should put it here. What I say this about a lot of models. After the first time they're a complete mess. Second time they're tiny. They're a lot better, but still, when you review them, you can't understand them. And by the third or the fourth time, hopefully you get this. Now, DRO balance, and you're going to say you still can't get it right, you idiot. To reduce the exposure. Okay, so then another question is, what happens to this DRO balance? Do you still get to use it again and again, or once you use it, does it go down? Now, I've seen different models, and we're going to have to add a little DRO balance account below that and allow that to go zero. So if we don't have any DRO balance left, we have an increase in the income, and that's what's happened over here. We have some remaining potential increase in income, I'm going to put from stop loss after the DRO allocation. So our income actually goes down. Okay. And then we can also, I'm going to take this out, but if the other, what you're doing is you're playing around in the partnership of just playing around with these accounts, and you're shifting income from the sponsor developer back up here. And if the sponsor has no income to shift around, you can't. You're still just going to have to take the loss. Okay. Okay, and then this income that you allocated goes back to the this is going back to the sponsor, and I better fix that again. Okay, so again, once again, this making the video forced me to go through this stuff that I'm dreading. I dread looking at this stuff, and I've tried to explain this a little better. So here is our DRO point. Not quite finished. The DRO right now does not go down when you use it. We'll fix that in a minute. And put an option. Perhaps it goes down, perhaps it stays the same. I've seen models both ways, but I haven't seen models where it's clearly laid out. So this is our DRO balance. Now, if we have a negative amount, we're allowed to take, this is deficit. And this, we want to reduce this deficit, and the obligation to reduce this deficit comes from the sponsor. So we're using their obligation. And then we're going to have to, this is the potential reallocation. This is the amount of, this is just a maximum of the minus or zero. This is just the amount we can reduce it by. And then we use the DRO to increase income to limit the increase in income for stop loss. Increases sponsor income. Remember, we don't want to increase income. We want to decrease income. We hate income on the taxes because we got to pay taxes on that. Okay, this is all where it comes into play. And here, in this case, we had a gigantic negative income, and I'm not exactly sure why this. We had a chargeback, and this this changes in the minimum gain here produced a whole bunch of income, which we'll get to. I'm going to have to come back and revisit that, but for whatever reason we have that. Okay, whether that's modeled correctly is a different story. I'm going to put an option for that in. I should have already had one. Okay, I'm very nervous, and I'm sorry I'm going back and forth, but I hope you can understand some of the ideas here. And it's good we have a big negative income that's more than our DRO. And of course, if I reduce the DRO, and that's what you'd want to see, of course, then what happens is there are more exposures to this stop loss, this negative subtotal. Okay, and then if we have to allocate the allocation of positive increased income from stop loss to the capital account. Okay, and we this is gone. Okay, and then our final closing balance it's kind of defined almost by the DRO. Okay, because if we had no DRO, okay, we wouldn't have a negative, we're not allowed to have a negative balance because it all gets captured in the increase in income. But with a DRO, and this is kind of one of the rules, this is one of the ones I was supposed to tell you, is that this final closing balance of the account can be negative. Now, okay, and let's just, so, I can't even, I'm saying, oh, like 1,000 times, I can't even kind of get it out. And I've got to pause the video again, and I don't care. I'm not stopping. I'm keeping going. Okay, I'm getting there, I hope. So what I did first was I included our little button for including the minimum gain chargeback, which is a decline in the minimum gain. So on this minimum gain, I left it just as positive. This makes sense, no problem. This minimum gain chargeback has the potential to reduce the balance and take the positive kind of effects of the minimum gain away from you. Okay, oops. And we'll leave it on for a moment, which causes a big increase in income. And then finally, so we get down to the after the interim balance, we get down to the final calculations, which are just that you take this interim balance, F2, and say, okay, I've just got to add back this income that I used for the stop loss. Now, if I put a zero, again, a zero DRO in here, that the account net doesn't go negative because the stop loss gets applied. That's the whole DRO. Ugh. And then finally, I said, okay, well, here's the adjusted. Now we have a, because blah, 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 because we have a stop loss, we have a higher taxable income. And because we have a higher taxable income, our IRR went from, it used to be 43%, and it went down to 35%. And this is just all the cash flow you get from the equity. And it even includes not much from the sale here. And the IRR went down to 35%. Now, if you would have made the DRO higher, you could have maintained the IRR, the really high IRR. If you make the DRO lower, then you get a lower IRR. But that's just the first step. We haven't even got to the next part. And in the next part, we look at the outside basis, the tax equity outside. I shouldn't call it outside capital this time because it's more like a asset accounts or tax basis used to compute stranded taxes from 731, I think. It's from, how about just excess dividends and suspended loss. Okay, so that's what's going on. And the first thing we do to compute this is if this, because it's a tax account, for me, this is so much more obvious than that horrible minimum gain stuff. We don't have any minimum gain to put in here. We don't have any dividend, the deficit reduction obligations. It's just since it's kind of like a tax basis, we take the equity and the share, the debt. So this is the total partnership liabilities. Okay, and what you do there is you okay, let's go through the calculation, and we might have to go up and down a little bit. And here, okay, I'm going to move this over just a minute. I think I'm not turning the thing off. We start with the same opening balance. Opening balance for outside basis. And when I first did this, I started with the outside basis, and I thought I had it because the outside basis is pretty clear, and everybody has one of these, and it's almost all the same in all those other models I showed you. Add tax, investor equity from sources and uses. Okay, and then you put less the distributions, and I'm going to again make this subtotal just an addition, so we just better put the additions of these distributions, and these distributions came from two sources. They came from K for those. Oh, it even kind of showed you. They came from the preferred distribution and the uh, uh, cash distribution. And these distributions, I just put it as K106, which again, I'm pressing just the control and the square brackets. Okay, there's our inside capital, and then I made a whole section for the outside capital. Okay, and so we have less distributions, and let's get this right. Let's put a minus here, so I'm giving up any thoughts of a positive number convention. And then we add positive income, not negative income. And we'll come to that below in just a minute. And the reason we do that, so we take the total income and just put a maximum of that number as 0. Notice again that the calculations really aren't that bad. And then if we have some income from when we sold the assets, I put that here, and I hope that I did not double count that. I'm going to assume I didn't. And then we put less 50% of ITC for immediate depreciation or a basis reduction. And that better be the same. I'm going to put a minus, and instead of putting the 50% here, I've got to be very careful because it's only 99% of the ITC. And I probably had a little bit of a problem here, and I'm looking for this. Come on, come on. Here's our ITC, and I think it was wrong before, and I put a negative sign on it, okay? And then we add, this big thing, is we add the initial share of the liabilities, okay? And that's going to make it into a asset account rather than just if you're putting up with me, this is kind of amazing. But I had this, you have to allocate the liabilities. Now, if you have 99% forever, that's very, very clear. Uh, whether you can allocate the liabilities, um, get my words out. If it changes to 67, that's another issue. But for now, I'm just leaving this as 99%. And I said, okay, we could put a little button say, no, we're not gonna allocate these shared liabilities. This is the debt, and then the debt goes down. So that when you add debt and equity, you get the assets, and this is basically the assets of the company. Now, here's what they do. Notice it's only positive income. When you take the opening balance and you add all the income and then you take away the distributions, in this period, you add a negative income and then the distributions are right up here. And then the tax person says, aha, you've made more distributions than your income, and they do this only with the positive income, and they call this, I hope it's a 731 gain. And all these people remember these horrible little stupid things, and maybe I still have it here. I have to look. If we look at the website and look at the outside basis, again, I've tried to cheat a little bit by putting my restructured models. And you see they call it 731 capital gain, 731 capital gain. And you can really show people how smart you are by remembering some of that stuff. Oh, you are so smart. And I better get back to the Excel. Okay. And then you're finished with that part of the subtotal, and that's just, again, all this formula is a maximum of the minus number of 0. You switch that to a positive. And then after you're finished with that, and why they do this, and one day I'm going to be able to explain this really well, why they only put the positive here. So this taxable loss, that's going to reduce the incomes all over the place. That's reducing the balance. But then when they make this test, they say, okay, you've got all these prior losses, but we just care about your positive income here, not your negative. Okay. That's an odd one. There must be a good rationale and a really good explanation for that. I'm going to find that one day. And then you put less the loss. And again, let's put a minus on it. I guess that's almost kind of ridiculous here. And then we take this one and we say, okay, here's what happened. We start with this, and then, okay, we're going to have, and let me put this up here, add excess distribution. We get because that's going to be that's a 731 gain. This increases taxable income forever, it's called a deemed sale. So when you hear these terms, that's where it is. But then we put the taxable loss. So then we can just take the sum of these things and get another subtotal. So this is kind of interesting. I've used this a lot since then. This business of putting subtotals in an opening balance and closing balance account. Okay, and then you're not finished, because this is the real problem. Okay, you've used all your DROs for everything else. To solve your problem up here, you've solved your problem with a DRO up here, but then you've pushed it down. I want to make some kind of push-pull, and what happens is this account goes negative, and this account is never on the closing balance allowed to go negative, and then you get to some suspended loss. And I've heard people say, oh no, why can't, and these suspended losses can kind of go backwards and become gains. It's just like an NOL account, net operating loss account. So if you have some negative balance and then positive balances, they can reverse. Okay, and these suspended losses are kind of like add the suspended losses, and this is like NOL and may, not absolutely will, be deferred. Because if we had a sale, then it's just sitting out there. If there's no sale, we can kind of get it back. And we can, let's put this in, and if we have no project debt, then we have a whole very different looking kind of situation. Okay, I hope you're saying, oh my God, that's what I gotta do. And on this one, I better put a negative amount. Now, what we'll do here, and this is where my less suspended loss, like use of NOL. That's, and a lot of people say it. And there's your final closing balance of outside basis, and this cannot be negative. Okay, and I don't care that I've been going on and on this one. I really don't. So I'm going to take my sale out. Now this suspended loss, like a NOL, and we start with our opening balance. We add the suspended loss generated from negative interim. I can't spell that. INTER. You know, I can't spell it. Subtotal. And I'm just thinking of my friend who gave me a lot of these models. He said, oh, I love this model. There were no spelling mistakes. Oh my God. Then I'd get really bad if I had a competition in models and I had all that. And then use of suspended loss when subtotal, I can't spell that as well, is positive. That's not very funny, is it really? And we use the famous max of that or zero to test when it's negative, to test it. And then you use a min max. And if you put it up here, you'd have a whole lot of stupid calculations. You need the opening balance here to do it. Okay? And then now, when I changed some stuff, excuse me, and now we have the uh, the tax investor with the sale, without the sale, with the debt, and without the debt. So now, when I've adjusted a couple of my assumptions, it made a really dramatic effect. And you better understand exactly how these things work. And I just recomputed this. And then finally, oh, yes, I got to put this deemed sale. We have the opening balance, and then we get to depreciate it. People go crazy. And that goes back up all the way to the goddamn, oh, I shouldn't swear, all the way to the, opening balance. Now, when you get this file will be there because right now you see it's called Jeff, and Jeff is one of the nicest guys ever. He said, well, I disguised some of those names and changed some of the assumptions and blah, blah, blah. I was debating some new names, but I better not get people in trouble. You know, I don't want to get And then I'm going to put DRO balance, and we put the opening balance less DRO used for uh, DRO used for limiting stop losses, and we put a closing balance. Okay, so and the opening balance is the first year closing balance is up here, and I might have to cheat just a little bit up here. Where is our D? I can put it here, okay? And we can put our opening balance equals our closing balance. Now, in some models, I do not see the DRO reducing like this. I would think logically you would do this. Notice I'm stuttering. I stutter when I'm not absolutely sure of something. So I'm going to put one of these little flags in, and I think I'm going to do that a little bit later. But we have our opening balance and then use of the DRO. And then our closing balance is the opening balance minus the use of the DRO. So we copy this across. And then, so our opening balance of the DRO goes down, and we can put up here a true false. I'm going to put in up here in our inputs, uh, yes, compute accumulated balance of DRO. So I already have it. So we're just going to put in here the little flag that allows the DRO balance to change. Okay, and we just multiply this by our number. Okay, so if I again copy our checkbox, okay, up to here, we can then, I'm going to have to put it just a little bit higher so we can turn it off. And if we turn it off, it just is kind of like the way I have it now. But if we turn it on, then we've got to make one more change. And then I am so happy because I'm going to stop this video. And we're going to put this opening balance of the DRO, and I've got to make one more stupid change because I don't know what happened to that. Okay, I had made a mistake, of course, and I had not used the 50%. Okay, and so now when I go up to this DRO balance, remember always, if you can, use the opening balance. Now, really, the thing that's missing here is the now our DRO exposure is a lot less, and if we put in a higher DRO, we get a higher amount. Maybe we can put even more than 100% here, huh? Okay, that measures the effect of the DRO, and when you really think about it, what's the cost of the DRO? Well, the cost of the DRO is that the sponsor will pay a little higher taxes. But if the sponsor doesn't give a crap because they got a gigantic NOL, the cost isn't that much. So when you sit here and negotiate a DRO, you got to understand what it's doing. All right, and you've got to understand what all this stuff is about. Okay, and now I'm back I've fixed some things, and now we're back to an enormous tax investor return and a much lower developer return. I'm looking at these and kind of putting the debt, and if we didn't have project debt, now it makes a really big difference. And the final thing to show you is, I shouldn't do this because it's probably going to be a mess. But this is where I tried to explain it. I tried to say, oh, let's go through first thing we test if there's a deficit in the inside capital, and then we go to the outside capital and we have the dividend test and we put all of those, and then I try to show a graph. I think I need a little waterfall graph of the waterfall graph of the IRR is easy, but a graph of what's really happening to our investment. And then we can even kind of put all of these tax issues in and say, what happens if we didn't include the minimum gain, blah, blah, blah. What happens if we didn't put in shared liability? So that's the way I've tried to model this. And I'm going to go ahead and stop this torture.